Hello, everyone. Welcome to the Rise Above Financial Literacy Session 4. Let's start with who we are. Hi, my name is Shamaya Jibril. I'm the founder and president of Executive Director of Rise Above Be Relentless Foundation. I have also a company, Phoenix Global Shipping, and I'm a licensed U.S. Customs broker. I was born in Eritrea, and I was raised in Alexandria, Virginia. My journey of childhood abuse and military service and survival of sexual trauma and domestic violence shaped this mission of creating Rise Above. This is also where we go while we exist. From a young age, we are told what we can and cannot do, what we can and cannot say. We are surrounded by those who put us into boxes. They try to mold us into identities that aren't ours. They define our limits and take what's not theirs, convinced they know what's best. But we're the overcomers, the ones who refuse to give up. Our experiences do not define us because we believe in the strength of taking back our power and choosing our own path. I know this because I lived it, coming to this country as an immigrant, surviving childhood trauma, and being in a home that was never safe, and taking my power back by serving in the U.S. military, becoming a Customs and Border Protection officer, and raising a beautiful child, and facing injustice at every turn, and then never giving up. Here I realized the shame was never mine to carry, and it's never yours. When you feel stuck, it isn't the end. It's just the beginning. It's time to get creative and stay relentless. Rise Above, Be Relentless exists so no woman or child faces that alone, because no one makes it alone. Helping survivors move from victim to survivor to overcomer, and then ending the silence that protects the abusers and replacing it with community, strength, and freedom. That's why Rise Above exists. We have the financial literacy, mental wellness, and legal clinic. The mental wellness and legal clinic will start next year, but right now we have the financial literacy. We want to empower you so that you know you had the power within you all along. We're just here to hold up the mirror. Our board members, we have Sabina Bundia, Treasurer, VP of Access Bank and survivor of domestic violence herself. Sabina leads the foundation's sponsorship and financial strategy with heart. Gloria used to be our former board member, but she's going to pursue other opportunities, and we are thankful for the time that she was with us. Shannon DeJean, she's our outreach chair and a Mid-Atlantic regional leader at Fogo Shannon brings hospitality and event expertise to partnership. David Benson, he's our secretary, CEO of Akatessa. He brings leadership grounded in service, resilience, and nonprofit governance and expertise. Stacy, she's our board member. She's a co-founder of Innovative Technology Associates. She champions families, education, and digital transformation. Our mission is to empower military and civilian families and women to overcome adversity with trauma-informed support, financial education, direct help, and a community so that we can turn pain into purpose and inspire generational change. Foundation's vision is a world where every woman, child, and family heals from trauma, supported, dignified, heals from trauma, and then they're supported, dignified, free from the shadow of abuse, and empowered to break the cycle and thrive with confidence. So what we're going to do is, before the financial literacy starts, we're going to do a little bit of meditation, guided meditation, so that we're very well prepared. Okay. Now, I would like you to close your eyes. First, get pen and paper for this meditation, okay? And then close your eyes. Find a comfortable position in your seat and or soften your gaze downward. All right? It doesn't want to let go. Getting on, so punch. So before we start the financial literacy and talking about homes, we're going to do a guided meditation and visualization exercise. So find a comfortable position in your seat. You can close your eyes or just soften your gaze downward. And before we start this, make sure you have your pen and paper so you can do the visualization. Take a slow breath in through your nose. Hold it in for a moment. Just do it 2 more times at your own pace. Breathe in. Now let your breath return to normal. And notice your feet on the floor, your hands resting on your lap or on the desk. In a few minutes, we're going to talk about money and home ownership, a topic that can bring up a lot of feelings, some excitement, maybe some doubt, maybe some old stories you've heard your whole life. And that's completely normal. For now, just notice, is there any tension in your body when you think about the word home, the word money? You don't have to do anything about it. Just notice it. When you're ready, open your eyes. On your worksheet, write down one negative belief you heard about buying or owning a home. It could be something like renting is throwing money away, or you need to be rich to buy a house. People like us don't own homes. Write whatever comes to mind. There's no wrong answer. Take a minute to do that. And pause this video if you need to. Now answer the next question. Where did you hear this? Was it a parent, a friend, something online, or a personal experience? Take another minute, pause the video. And last question. Do you think it's actually true? Or is it a story you have inherited from someone else? Write a sentence or two. And take 90 seconds to do so. Once you're done, we're going to do another visualization. You can close your eyes again if you're more comfortable. Take one slow breath in and out. Picture a future version of yourself. This version of you owns a home. It might be years from now, and that's okay. See yourself standing outside of the front door. What does that door look like? What color is it? You reach into your pockets and pull out safe keys. They're yours. You unlock the door and step inside. Look around. What's in this home? Is it big or small? Simple or full of things? Notice how it feels to stand in a space that belongs to you. Is anyone else there with you? Family, a partner, a pet? Or are you alone, enjoying the quiet? Notice who's around. Now think back. What steps did this future version of you take to get here? Did they save a little every month? Learn something new about credit or budgeting? Ask for help when they needed it. This future you knows about the belief you wrote down earlier, the negative one. What would they say to you right now, sitting here today, about whether that belief is really true? Take one more breath. And when you're ready, gently open your eyes and come back in. If anyone wants to share, you can share one word or how the visualization felt in the comments. Or you can share what surprised you about the gap between the beliefs you wrote down and the home you just pictured. No pressure to share, but if you feel like it, feel free. Keep that image in your mind today. And we're going to talk about some real concrete steps that gets you from where you are now to the front door.
Hi, everyone. My name is Sabina Buendia. I am a commercial banker. I work for Axos Bank, but I'm not going to talk about my bank. My goal is to talk about financial literacy, teach women and men, and empower them when it comes to finance, credit, home buying, or any aspect of banking and finance. I've been doing that for past 7 months, but I've been doing financial literacy for many years. And I helped teenagers, adults, young adults, or older adults to learn about finance. So if you don't know much about finance, please don't feel guilty because it's a very complex topic. And also, I've seen a lot of successful people that they're very good at what they do, but they have zero idea about finance. So that's why I'm here to support them. They can focus on their businesses and growth, and then I can focus on actually helping them grow their businesses and get their financing and move to the next step. So this is our fourth workshop. We talked a lot about credit, how to build credit, what credit is, what you need to do to improve your credit, a lot of things about credit. We talked about bank accounts. We had different strategies, but today we dedicated for home ownership. And a lot of people think that, oh, I am too young for that. I don't want to hear. But it's never early. We have to understand where you want to go today, and then you can actually create a path, right path, So when you are in that right moment, you're going to be ready to purchase your first house. So who can tell me, you guys can share, all of you, where do you see yourself in next 1 to 5 years when it comes to purchasing your house? For example, like how many years from now you think that you're going to be purchasing your that house? First house, second house, whatever it is.
Long years, because I think the renting is really expensive and it feels like reasonable to buy a house because the loan and the rent for every month is almost like the same.
Or more.
Yeah, yeah, I think
It's more actually.
it's more, but you can get the asset. But I think the interest rate is really high this year.
That's a good, you're going to touch that topic, okay? What about you?
Probably 5 years.
5 years, okay, that's a good plan. Okay, how about you?
Really looking at a similar timeline. I want to have my student debt paid off in 3,
Yeah.
and that starts really saving, put her down.
Okay, that's great. And you can also do at the same time some putting towards your student loans and some saving. So that way, because student loans can take lots of years, and student loans have actually lower interest rate. Yes, so it's good to pay down, but at the same time save money when it comes to that. And you can always talk about that as well. So click please. Yes, boss. So today, what we're going to talk about is understanding the path of homeownership, learn how credit impacts mortgage approvals. That's a very big one. Understand FHA loan requirements. Do you guys know what FHA loan is?
No.
Okay, great. I am excited now. Learn how interest rates affect affordability and discover first-time home buyer resources. Build your personal action plan. So every time when people come to my financial literacy, they have to do homework when they go. That's the action plan we have. Next. So the question is, click. Unclick. Okay. What's your biggest homeowner challenge? So there are 4 answers: saving for a down payment, credit score concern, monthly affordability, and not knowing where to start. Which one do you think is the biggest impact for you?
I personally think it's a credit score concerns because I only come here about a week.
A week?
Yeah,
You've been here only a week?
yeah, I'm here to visit.
And where are you from?
I come from China.
Oh, nice. Welcome. That's awesome.
I will stay here for about 2 or 3 years. So I think it can be meaningful for me to buy.
And that's a very good thing. So you're here, you need to build credit, because either if you don't have credit or if you don't have a status, you have to pay money out of your pocket to buy a house.
Yeah.
Or if you want to take the traditional path that we do in the United States, we have to build credit. Credit is your trustworthiness. When we look at your credit history, we're going to see how you pay your credit, how responsible you are, what your patterns are. So that is basically paints the picture for creditors, bankers, like, and then we say, you know what, this person is very responsible and she or he qualifies for this much based on their salary, credit history, because you have to make money. You have to make money, you have to work to make money. And because we want to make sure that you are able to pay every month your mortgage. Okay. And we have different types of mortgages. We have 30-year mortgage, we have 15-year mortgage, we have 10-year mortgage. They're so very different, but the most traditional one is 30-year mortgage. Yes, 30 years. And so for you specifically, you need to start building credit in the United States. And if you have social security number or tax ID number, you can get secured credit card to start building your credit history, because they're not going to give you unsecured credit card because you do not have any credit history. So secured credit card, basically you deposit $300 or $500, with certain banks actually have secured credit cards, and then you get a credit card. So you start using that credit card. Doesn't matter where you use, but you need to use it paid back. That's how you actually bring your credit score up. And in 3 years, 2 years, even you want to buy a house, they're going to look at your credit history. And if you come and work over here, then salary is going to be another factor that you're going to be making money and you're going to have a credit history and you can get your mortgage. Okay.
Yeah.
Any questions about that?
No, I think expressed very clearly.
Okay, great. Awesome. So for your credit score, what about you, Lucas?
A little bit of A, a little bit of D. I haven't done a whole lot of planning yet, so
Okay.
it hasn't feasibility answers that I need.
So you're my good student. You're going to learn today.
Yes.
Absolutely.
Yeah, a lot of people actually, they're struggling with saving money. Okay. We are living in the United States. We are living in one of the most expensive counties in the United States. The cost of living over here, it's ridiculous. Okay. It's very exaggerated, but we chose to live here, so we don't have any other choices. If you go to middle of the United States, it's going to be completely different, but you are not going to be able to see what you see here, okay? Because we are very diverse. We have everything that you're looking for. It just, life is completely different here, but you pay what you get what you pay for, okay? Say habit as well. For example, for me, every paycheck, certain dollar amount from my paycheck directly goes to my savings account that I don't see, I don't touch. I think that money does not exist. The reason I do that, and then I named that account. I put Portugal Dream House because I want to buy a house in Portugal. And that's the name of my bank account, Portugal Dream House. That money goes there, accumulates every year. I build certain, because I have a goal. Each year, I want to make this much money. I want to see this much money in my savings account. And then once in a blue moon, I log in and check to see what I have there. And I also do this. That account is not tied to my regular household account or regular bank account. This account is with a credit union that it's not easy to have access. It's not easy to take the money out. It's just a very remote account that I cannot take the money out because I restrict myself from seeing and touching and using that money. That money cannot be touched, cannot be used. Even though I have emergency, I will never touch that money. So that's my rule for myself. I have money saving for my house. It's just in case something happens to my house, then I will use the funds from there. I have money for my car insurance, my yearly tax, everything or any maintenance that I need to do for my car, that money comes out of that account. So I strict myself to do things differently. So that way I can save money the way I want to save. And saving for down payment is another option that it doesn't have to be $1,000, $2,000. It can be $200, $500. You have to start today. And then when you think that, okay, you have a salary increase or you got a new job, then you can switch the dollar amount higher and higher every time. So that's how you're going to be able to save down for down payment, because having down payment is extremely important. How much do you think, what's the percentage of down payment you have to put down when you buy a house? Just guess. You said 20. That's that's true. It's traditional, 20%. What else do you guys think?
5%.
Okay. And then that's with what?
I think that's with the first time home ownership kind of thing with the state.
Okay. And then there is a VI loans. You guys do
VA
different-
loans?
You guys
Yeah.
do completely different. So there are different types of loans. We're going to talk about it. Okay. Let's go to next screen.
Okay.
So these are the steps that we all have to take to buy a house. You have to build your credit, number one. Without that, you cannot move forward. That's the first step. Number two, save money. Save money for down payment. Number one and two, there are two important things. Number three, get pre-approved. Do you guys understand what that means? Pre-approval? Okay, you have the down payment and you have a credit, good credit, excellent credit, whatever it is. And you want to know how much you're qualified for. Okay, where do you think you can get that pre-approval?
Bank.
You got it. Bank, mortgage specialist. You go tell your mortgage guy, say, here is my information. This is my credit. They're going to ask you questions, credit score, your salary, a bunch of information they're going to ask you. And they're going to qualify you based on your credit and based on your salary. And they're going to say, okay, Sabina, you're ready. You are able to afford up to $350,000 mortgage. Okay. And then once you get pre-approval, then you're going to start shopping for your dream house. Okay. And the first time, guys, let me give you a bad news. You are not going to get your dream house. Okay. You're just going to get a house. The house that it's affordable house that you think that it's good. And then your second or third house can be your dream house. And then you get for your loan approval. Once you find a house and you bid and they say, okay, you got this. And then your mortgage guy is going to be qualifying you for a loan. They're going to be issuing you a mortgage. Okay. And then closing, there's a process, 30 days, 60 days, depends because they need to come and look at the house, make sure that everything is good. And then they close, and then you can move in. Okay. A lot of people, guys, start with step 4. They're looking for a house without knowing what's going on there. But step 1 and 3 is the most important ones. You guys have to take baby steps, making sure the building credit, saving money, and getting pre-approval. Yes.
What if your partner is the one who's angry at the earning person?
Then you will get joint mortgage.
Lori, what are you saying? Because they're the one that are making the decision, or?
For fun,
Money. Okay, that's fine. But you have a good credit.
I have,
Okay, and he has a good credit.
yeah.
So both of your credit can qualify with his salary.
Was it possible if I, as a first-time home buyer, but I'm staying on loan, get extended to in her name? The asset is not in option.
Deed can be under her name, but mortgage has to be under his name. So there are 2 factors there. Deed of the house, who the house belongs to, and the mortgage, who got the money to pay. So there are 2 factors there. So I can have the deed under my name, but mortgage is joint.
Or he pays all the mortgage and your name's on the deed. Ideal.
Yeah. He is responsible because bank is paying him money. He's the one who is responsible for mortgage.
Sorry, if I were to buy a house under my own name,
Then you have to make money.
have
Yeah.
to provide a salary.
Correct.
And-
It can be salary if you have a business, you're a business owner, you make money, you show that as well. It doesn't have to, you don't have to go work for Uncle Sam. You can work for yourself and make money.
Can they be part-time or has to be full-time?
If you make part-time a lot of money, why not? It depends how much money you're making.
And also, how much is the loan? If the house is $400,000 and you're only making $25,000 a
It's
year,
not gonna work.
you're not going to qualify. So it's like,
So they will qualify you with your part-time salary.
yeah.
Okay. So maybe your part-time salary is going to qualify you for $150,000 mortgage. And that's what you can go look like apartment or something like that. It's not, oh yeah, you cannot do it. You can do it. It's just based on what your pre-approval is. Okay. So not here, not in this county, but down south or Midwest, you can actually buy a house for $100,000, $150,000.
I'm from Michigan.
Oh, here we go. Here we go. Michigan, you can find not yeah.
Yeah.
Yeah, over here it's very, very expensive. Yes. Okay. And let's move to the next one. So guys, this is very important to understand. So there are 5 different ratings. Okay. Credit score starts with 300 and goes up to 850. So 300 to 579 is poor credit score. No, you are not going to be able to get anything approved. Okay. From 580 to 669, it's fair. Over here, we can start getting the approvals. 670 to 739 is a good credit. And 740 to 799 is very good credit. And from 800 and up is exceptional credit. Okay. And why credit is very important, guys, because it helps you with the road approval very quickly. Interest rates can change based on your credit history and credit score. monthly payment can range from low to high based on your credit score and loan options. So when you have very good and excellent credits, you hit all those four criteria. Your loan is going to get approved very quickly. There's less headache. Your interest rates are going to be lower when you have a higher interest or a higher credit score. Monthly payment, that actually interest rate being lower impacts your monthly payment tremendously. You will have a lower monthly payment. And then loan options, again, you will get the best loan option possible out there. And a lot of mortgage companies are going to be able to give you actually better options. Okay. Any questions about this?
Too soon?
Read this one.
So better interest rate or maybe that is an option then they
But credit, better
Better
credit, better credit.
maybe lower monthly payment.
Correct. Because why do you think it's lower monthly payment? Because your interest rate is going to be lower. So if you have a lower interest rate and your mortgage is 30 years, think about that. How big impact it's going to be on your monthly payment. And I will give you some examples. Okay. So acceptable credit scores for home loans. So these are the different types of home loans they have. Most of the time, conventional credit score starts around 620. I would say it starts 620, but it's not ideal. Usually 680, maybe you can get good credit, good stuff. FHA is 580. FHA is the first time home buyer program, which we're going to be focusing on that and we're going to talk. The credit score starts around 5. This is actually not a lot of places can have that type of loan, but this is like a rural areas that they want to bring more people and grow their population. Then they offer different type of mortgage, and then their credit score starts at 640. And is a veterans mortgage. Basically, you have to be in military to get qualified for that. And then if you want to get best mortgage rates, credit score starts around 740. That's very good. Yes.
Can I speak on the VA
Yeah, go
loan?
ahead.
Okay. So for the VA loan, there is let's say you served, you're a veteran, no disability, you come out. You still get VA loans, but there's a percentage that you have to pay. I think it's called. And it's very low.
Percent.
Yeah, very, very low. And then, but if you have like certain disability or it's higher than that, then you don't have to pay, what do you call it, down payment, because the VA is guaranteeing your loan.
It's a basically government loan.
The government loan. And there's also, if your rating is high, because they have like this, Lucas, can you look up the VA? Let me look it up real quick. Because I want to make sure I give you.
So while you guys looking up, just want to let you know that you don't have to have a perfect credit to buy a house. A lot of people think about that. Oh, I have to have a perfect credit to buy a house. No, you don't. Again, you get what you paid for. Yes. If you have a dream of buying a house and your credit score is around 580 or 600, you still can buy a house. And then if you're a first time home buyer, FHA is the best way to do it because there are a lot of programs out there, and FHA is one of those programs that actually helps you to buy your first house. Please, we're going to talk about the down payment options and qualification. Go ahead.
Yes, I got it. Thank you. So for a first time use, you have for the VA 0% down. There's about 2.15 funding fee that you have to pay. And then it's 5% to 9 down for if it's your first time and you're getting a second one, then it goes up from that. And then veterans with VA disability at any level, they're 10% or higher, they're exempt. They save about $4,300 to about $1,000 on typical purchases. And then, but if it's like, I think it was like more than 90 or you're 100%, then there's no funding fee. You don't have to pay down payment, and there is no funding fee or closing fee that you have to pay. So it's just, you go, they're like, here's your mortgage, and then start paying on it. The closing fee you might pay, but no funding fee.
It can be up to 15,000, but you guys get discount on that.
Yeah, they reduce it. They reduce it significantly.
Like if we pay 15,000, they will pay 4,000 or 6,000.
I think that's what I did for my first home. I paid $4,000. No, I actually got back because the real estate agent was really good, but I got money back.
Oh, that's great.
So
let's go to the next screen.
So if you're a veteran, look into it. Like this. That's good.
Is there any limit in the whole price for the at the FHA house, the house price?
Yeah, you get the loan is based on the amount of the loan.
Of the house, right?
Yes,
Of the loans. Yeah.
Exactly. So let's talk about what impacts your credit score. And payment history is 35%. So when you are using your credit card, your loans, like car loans or personal loans or credit cards, payment history is 35%. That's actually really high, which means that you have to make your payments on time. If you're one time late, that's going to impact you. And owning amount owed. So typically banks, we look at your limits and your balances, how much you owe on your credit card. You cannot go more than 30%, but we prefer 15%. So basically if you're using your credit card, you have to make sure that you're paying it down so it doesn't affect your credit, okay? Length of credit history is 50%. So we look at how long you had that credit card or when you start building your credit, because longer the credit history, more trustworthy you are, and that's 15%. Credit mix. So credit mix is we see how many credit cards, personal loans, auto loans you have under your credit, under your social security number, and how you're utilizing that. That's 10%. We like to see not just the revolving, credit cards are revolving credit. We like to see loans as well, paying it down. Okay. And new credit, again, that's 10%. See how new your credit is. Those are the factors actually impact your credit. So when you're building your credit, you have to pay attention to that. Any questions?
For my credit, should I use only one credit card or I use different kind of credit cards?
I want you to use more than one credit card
More than
because we look at the patterns. So you have to have at least 2 credit cards. And I always say I prefer to have an auto loan, a personal loan. Auto loan is the cheapest because the interest rates are low. That shows you credit trustworthiness because it's a fixed payment, fixed term, fixed interest. And then you are paying it down. Then you're paying it down, which means that you are responsible. You are not late on your payments. Your balance is decreasing. So that actually helps to build your credit. So a lot of us, we have mortgages. And so mortgage is one of the factors actually banks look for to see how good you are with your payments. If you miss one payment, mortgage payment, that ruins your credit history and you cannot even remove that from your credit history. Just one payment, even one day. So you have to be extremely careful with the mortgage. Okay? Yes.
How many credit cards are too many? What's the ideal?
Ideal is 3.
Really?
Yeah.
Oh, sure.
Yeah. You don't
That's like wanting me to like just carry up this color.
Yeah, you don't want more than 3 and you don't want less than 3 either. The reason I'm telling you there is a credit limit. When we're saying credit limit, we look at your overall credit card limits. So your first card can be 10,000, second card is 5,000, and third card is 7,000 or whatever. Like altogether collectively, you have 30,000 credit limit. Yes. And from that 30, the higher your credit limit is, your usage percentage actually lowers. And you remember we talked about 15%, 30%? Because we look at your overall credit limit.
Right.
So that actually impacts it. You have more credit limit, which means that if you use more, the percentage is going to be less. But if you have a lower credit limit, even if you use $1,000, it's going to impact you. So that's why having 3 credit cards. And if you have a large purchase, use your larger credit limits. So that way it doesn't impact your credit, that you are using 50% of your credit because you bought something for $5,000 and you get it to $10,000. So a higher limit, it's better. And I always tell my people that once a year, every 6 months, go to your credit card and request credit limit increase. So that way they look at your credit, they look at your trustworthiness, and they increase your credit limit. They don't pull your credit because your information is already in the system, but that helps you to increase your credit limit. Okay. Next. Yes. So 5 ways to improve your credit score. This is very important. I always talk about this. I'm always going to talk about this. What you need to do, pay every bill on time. That is must. That is must. Pay down your credit cards. Do not keep balances because interest rates are so high, especially if you have rewards credit cards. Those interest rates high. They start at 26% and they start to 32%. So it's because they're paying you rewards, but they have to make money somewhere. Yes, they make money off of you because you're paying interest if you're keeping the balance. So therefore, pay down your credits. And there are 2 methods. We talked about avalanche method and snowball method. Basically, either you pay down your smallest credit card or pay off your smallest credit card and move to next one, or pay down all your credit cards. I always prefer to pay off smallest and move to next, pay off that and move to next. So that way, you clean up your credit cards. And just paying up gives you satisfaction as well. Okay. Review your credit report. How often do you guys review your credit reports? Never, once a year. What about you, Lucas?
I try to do it around like once a year.
Okay.
Like to actually look people that are saying into my bank and limit.
Okay.
Once a month.
So all of you have bank accounts. Your bank, every bank has FICO score.
Yeah.
Click on that FICO score. It will give you full report. That's how you're going to review it. And once a year, you have access for free credit report. And you can actually review your credit report as well. Another thing I love, Credit Karma. It's free. You guys can download that. Credit Karma will tell you what you're doing right, what you're doing wrong, why your credit increase. Well, you paid your credit card off. It tells you, great job. Your credit score went up because you paid your credit. So Credit Karma is another great app that you can use, and it gives you real-time information as well. Okay. Dispute errors. That's why you guys have to review your credit history, because sometimes somebody else's information can actually show up on your credit history because your name's matched or your social security was stolen, or things can happen. So if you see something wrong, you need to definitely report to credit bureaus and file the dispute. So all 3 credit bureaus can actually remove that information. What you don't do, never miss payment, guys, and never max out your credit. Your credit cards cannot be maxed out because that shows very bad credit usage. And open unnecessary accounts. That's another thing. Do not open every year. Oh, I want to go buy Neiman Marcus something. Let me go get a credit card. Or Victoria's Secret. Let me get a credit card. Or I don't know, Saks. Don't do that because I don't like store credit cards. I'm not a big fan of store credit cards. And I'd rather to have a credit card that it helps me with travel or it gives me higher points that I can use anywhere. So don't get store credit cards. Those are not good. Those are traps, and you'll make you spend more money. Okay.
So
Yes.
you recommend swing credit in salary.
Oh, yeah. I love that. I love it. So credit cards are differentiate based on your needs. Okay. Based on your credit history, based on your salary. So, and also some credit cards have annual fees. So important question is that, what do you want? Do you want to have a credit card with no annual fee and earning decent rewards and, domestic, or you want a credit card with international usage that you don't pay international fee? There are fees that if you're going to overseas, you're going to be paying. And with those cards, like for example, I have several cards that I use. I'm big Chase fan. I have Chase credit card. Chase actually offers really good credit cards. Capital One is another bank is offering really good credit cards. But like you have to think about what the annual fee you want to pay. So Capital One has a Venture X credit card that annual fee is around 1050, and then it's a 2% back points every dollar you spend, nor international fees, and also it gives you lounge access, priority pass, and Capital One lounges, and comes with tons of benefits. I compared that to Chase Sapphire Reserve, which annual fee is around $800. So for you guys, I will never recommend you to get Chase Sapphire Reserve because $800 you can save to go towards the house that you want to buy. Okay, even Chase, even Capital One credit card, $350 is kind of high, but they're give and take. Yes, Capital One gives a $300 travel credit as well. So there's $50 left. And then with other rewards options, you basically don't pay for that credit card because you already get benefits back. Okay. I mean, if you don't want to pay that annual fee, then you can have other credit cards that Capital One offers, which is great as well. So it depends. I recommend you to do your homework. You can even ask our friend ChatGPT. Just say, I don't want to pay this. I want to get this, or do the you put there what you want, and they will recommend you actually really good credit cards based on what you want. Okay. Okay, here we go. I want to give you examples, guys. So credit limit is $10,000. Your credit card is $10,000. You have an $8,000 balance. Your utilization is 80%. When we say this, we're saying, you know what? No, we are not giving you anything because you are almost maxing out. 80% utilization is no. We don't like that. Look at over here. Balance is 2,000. Utilization is 20%. That's a much better because in 2,000, you're utilizing only 20% of that. So one thing I want you guys to understand, within a month, if you buy something for $9,000, but within that cycle, if you pay it back, that's not going to be counting towards your utilization because you already paid back. But if that statement cycle closes and you still have $8,000 balance, then we will report you to credit bureau that you are keeping $8,000 balance. But if you buy something and pay within that cycle, that's not going to go against you. So a lot of people always question that. Then like, I bought something wrong, I paid back. Is it going to be against me? No, it's not. As long as within that cycle, if the statement doesn't close, then we are not going to report. Okay. Goal is always below 30%, but 10% is ideal. 10% of your total credit. Okay.
Sorry,
The statement cycle ends. Like, because you have 25 days.
So I already see the state.
No, not that statement. Like, your statement closes, that's prior months, that's fine. But your new statement cycle is from, for example, 1st of the month to the 30th of the month. That it is in that frame. If on the 10th of the month you bought something and on the 15th of the month you paid that, that's not going to report as a balance because you paid up. There is nothing to report. Exactly. Before that statement comes out. Yeah. If you do that, then when the statement comes out, you are not going to have a balance to pay.
Because I was always, I'm just like figure the last balance.
No. So this is about the limit. Remember, we talked about $10,000 limits.
Right.
You bought something for $8,000. If you pay that within that cycle, they are not gonna, we are not gonna put it on your statement. You see what I'm saying?
Yeah.
Yeah. So that way, it's not gonna show that you utilize 80% of your credit. Because every time when the statement closes, we report that.
Yeah.
That's what I'm saying. I don't want to report you, pay your balance, so I don't report you. I will report you with 0, or I will report you with less than 30%. but you paid most of it and then you have little balance left, and the statement shows whatever you have left.
If I always use less than 10%, should I
That's fine.
that
So
or
if you use less than 10% and if you don't want to keep a balance, yeah, you can pay off. Like for me, my habit is if I buy something, as soon as I use my credit card, I pay it up. So then I don't keep a balance. I don't have to worry about my statement, what statement is going to come and what is going to be reported. Yeah, just that's my habit. Like, I don't like to keep a balance. Okay, what's next? Okay, now we're going to talk about first-time home buyer. It's called FHA. FHA stands for Federal Housing Administration. So Federal House Administration, FHA, does not lend money. They don't have any money to lend. That's the program. The FHA actually, every bank, every loan, whatever originator has a FHA program because it's a government program that it can be embedded, and for only first-time home buyers are qualified for FHA. So if you never had a loan, if you never had a home in the FHA loan, okay. So benefits is lower down payment, okay, easy credit qualification, competitive rates, and gift funds allowed. So that's another important thing that we can talk, and great for first-time buyers. Do you understand what gift funds mean?
just genuine by far?
Correct. For example, your sister, your uncle, your father, your mother can give you a gift for the down payment, so you can buy your first house. So in the United States, when we are qualifying you for a loan, we always have to trace the money, where money is coming from. Okay. Because that's very important. You just cannot deposit money into your bank account and tell me, here, my money is here. You're going to say where that money came from. So, but if here, for example, if my mother is giving me money, she's going to write a gift letter that I'm giving this gift for my daughter for the down payment. So we accept that for FHA. Lower down payment, guys. This is very, very, very interesting because we talked about typically, if we are not a veteran or we are not in the army, we pay 20% down, correct? That's what we heard. That's what we think it's going to happen. But no, with the FHA, actually, it's 3 to 5% you put down. You don't put a lot down. So instead of putting 70,000 down, you put like 20,000 down, or like less than that, 12,500. And we talked about the qualified credit is around 580. So it's very, very low. And if you're building credit, that can help you as well. Any questions about here? Because we're going to go more. We still have more conversation about FHA. Okay, here we go. This gives you an example. Typical FHA guidelines. Credit score starts at around 580. Down payment is around 3.5%, which is fantastic because imagine 20% down versus 3.5% down. And then look over there. For $350,000 loan, FHA down payment 3.5, you're going to need only $12,250 down versus $70,000. Look how big the difference is. Primary residence, that's the very important. You cannot buy, I don't know, investment, but because you don't have a house, this is first-time home buyer, you have to be residing in that house. It has to be primary residence, okay? Stable income preferred. So you have to have a stable income. You have to work something. Debt to income ratio. You know what that debt to income ratio means?
How much time do you
You got it. So it goes close to 43 to 60%. Actually, conventional is actually longer than that. So we look at 35 to 40%. So debt, which means that all your credit cards, your loans, auto loan, personal loan, all together, how much you owe compared to how much you make. That's the percentage. Yes. So we look at that too. We want to make sure that you are around 43 to 50%. Okay. You cannot go more than that, or else you're not going to be qualified. Any questions around it?
Against lower is better.
Lower is better. Yeah, but then cannot be higher. Lower is better. Yeah. So because it's conventional, we are looking for lower than that, a lot lower than that. But this is because this is a program, so they give you leeway. They say, okay, it's their first time, they're learning. Let's make sure that they understand how it works. So that's why they give you a little bit of grace over there. Okay. Okay. And I wanted to compare FHA to conventional. So FHA, the credit score starts 580, conventional is 620, down payment is 3.5, and conventional, it depends. They actually put all together between 3% to 20%. Qualification flexibility is a lot higher in FHA and lower because they want to make sure that you're qualified. And mortgage insurance is required, and it depends. So mortgage insurance, do you understand what mortgage insurance is?
Insurance on your mortgage, just in case you get sold on.
It's called PMI. Do you know?
Depending on how much you put down, right?
You got it.
You must put down a certain percent already monthly.
Correct.
To reach out, right?
Correct. It's PMI. So because you're putting 3.5% down, you have to get the PMI, mortgage insurance. But you can actually pay off that, and then you can refinance and get rid of that PMI. But PMI is required for FHA. Okay. It's a different kind of insurance that you are buying for this specific mortgage because you put less down payment. It's called PMI. So you have to do premium insurance. But like within 1 or 2 years, you can actually refinance and get rid of PMI once you have the equity on the house.
So they're basically saying, hey, you don't have enough money. So reassure us with this insurance. Because what happens?
So it's not the insurance. The payment is not high. That actually rolls into your monthly payment. You don't see what it is, but it's basically assurance. It's an assurance bond that you are buying to make sure that, like, yeah, I didn't have money to put it down, but I got the insurance to buy the house. Okay. But with the conventional, you can get PMI, but it's based on how big the mortgage is. But usually you don't have.
Okay, good. You have a question?
What's the typical like amount of down payment at which you have to do your EMI for
20%.
20%?
Yeah, that's typical. Yeah. Okay. So credit score and mortgage payment example. So this is actually eye opener. So if you have 660 credit score, your rate, and then these rates are not like, it's just the example. Because you have 660 credit score lower, your interest rate is going to be higher, 7.25. And your monthly payment is going to be around 2,388. If your credit score is 700, it goes 6.75. Your payment is going to be 2,270. If your credit score is 600 and up, your rate is going to be around 625, almost 1% less, and your payment is going to be 2,155. So it's basically, this is an example, like how the interest rate and the payment can change based on your credit. Okay. This is very important, guys. You can take a picture. I already put it on our paper as well. Resources. Do we have the resources there?
Yes.
Okay. Yeah, right here. Yeah. But take a picture of this. This is very important. These are the information, the resources about housing, FHA, Fannie Mae, Freddie Mac. These are the different types of mortgage originators that you can find a lot of information about first-time home buyers. Okay. Again, FHA is the best way for first-time home buyers. I don't even want you to think about conventional. And if you are not in VA, don't worry about VA. There are a lot of different loan programs and grant closing cost assistance, down payment assistance in the counties that you guys live in. So therefore, you have to do those researches as well. As long as you're a resident, you can qualify for a lot of things. People don't know much about this. So that's why educating and providing resources is very important. So nobody knew about FHA until we came here, correct? Yes. So now you know that you can buy a house with 3.5% down payment. Well,
You're too low. And you're like,
not really. Yeah, a lot of people buy first-time home buyers and use FHA. It's just the way how United States is built and how we function here. And as long as you're paying it on time, you're not missing payments, you're fine. In within 2 to 3 years, you can actually refinance the house and then get out of FHA and become conventional and get rid of your PMI as well.
So is the government helping you as well? Because
Yeah.
to also own a home, so they can compete with the other people who have a lot more money.
Yeah.
So it's a kindness.
So if you're buying a house for $350,000, your mortgage is gonna be around less than $2,500. But you're paying that $2,500 in rent from you, or even more if you want to get bigger. But and then it's an apartment. You cannot even get a townhouse. Townhouse is starting around $3,000. Depends where you are. So instead of wasting your money on rent, you can put that money towards your mortgage and build equity. You know what equity means? Okay. Equity is the mortgage, the house that how much your house worth and how much you owe. And in between that, there is an amount that called home equity. That's the amount that you actually pay down and your house worth more. And you can actually borrow against it again, called home equity line of credit. But you don't have to borrow. That's your asset. That's you paid, for example, your mortgage is $350,000, but your house worth $500,000. What is your equity there? $150,000. You earn it by you
sell.
Yeah, I mean, yeah, that's right. If you sell it, yeah, you will have that money.
But like the more you pay,
that will help you with your refinance as well. Because when you refinance, they count $500,000. So you can get rid of your PMI as well.
yeah, and then if you, even if you're not selling it, I guess
Even you refinance,
what I'm saying is like
equity.
the equity is you can take out the money even if you don't refinance.
Yeah, you can.
And you're not
you can take a home equity line of credit.
Yeah, to pay any debt you might have, or
Yeah.
if you want to
If you want to
revamp
be-
your house.
if you want to add addition, or if you want to renovate, or if you have a lot of debt, you want to do debt consolidation, because home equity line of credit has a very low interest rate. So there are different factors. But I don't want you guys to think about that. The focus is how we can buy the house.
Not how to loan
Yeah,
against.
not again get more loans. No.
That's so funny.
So checklist, guys. Everybody's gonna go home and check their credit score. That's the homework. And think about your credit cards. If you don't have a balance, amazing. If you do have a balance, what action are you gonna take? Are you gonna be paying off the smallest one and move to the next? Or are you gonna pay it down? Think about it, because we don't want to keep balances there. Build emergency savings. Think about how you're going to be contributing towards that savings. $20, $100, doesn't matter what it is. Just put that in the savings. And it's never early to meet with the mortgage professional and talk about your options, because they can give you a lot of valuable information and tell you, start here, do this, and then in 3 years, let's meet and talk about it. So it's very important to understand how mortgage works and what you can do to get to that top doing first time home buyer.
And
FHA.
Do you have a maximum?
Maximum, I mean, you're the first, and the requirement is you have to be a first-time home buyer, and it has to be a primary residence. That's it.
And do you have like
Yeah, you can have multiple savings accounts. I have so many savings accounts. I have shoe account, purse account, car account, whatever account.
I started doing that. I put cars, I put travel, and it really helps. 'Cause you can see.
Amazing, because I don't touch my travel account because that's my money when I travel. I don't touch my car account because my taxes, my maintenance, everything comes out of that car account for my car. My dream house, I cannot touch. I have to have another savings for emergency. Then, so I don't touch that either. So there's so many things that I have savings account for my kids. There are different factors that's based on what you want.
so that we don't have that?
No, because it's a bank account.
It's a saving account.
Yeah. Yeah, debit cards, bank accounts, unless you default and they charge off your account, it's not going to be reported to credit. Okay? You love it? So yeah, we're done today.
Yeah.
Any other questions?
No, thank you
Yeah.
so much
Well,
for
thank
joining.
you. I appreciate it.
This will be recorded. We will upload it in our YouTube channel. And then we'll also send it to you guys. Really appreciate you joining us and ask beautiful questions. And if you guys want to take the to-go, please feel free. There's to-go plates there and water. Thank you so much, Sabina. She gives us her time, and we appreciate you.
No, this is so well, and recently helpful. About what you did not
Oh, I love that. I'm so glad to hear it.
for your benefit.
You guys are so sweet. I'm gonna send you guys a survey. If you could write your email on the back of the sheet with your phone number, and then in our financial literacy, we ask you like just a cute survey and 3 to 5 sentences why you need the 250 a grant that we give towards utility payments, childcare subsidy, or like career certification, and then tell us your need, and based on that, one woman gets to win that 250. Yes, please put your information. Actually, I'm going to have you put your information on a laptop, and then we'll go from there. Okay. Okay. Thank you so much, Serena.
Yeah.
Bye, Hope.
Thank you.
I'll send you the survey. Okay.
Okay, tonight, right.